last time we talked was in April, and we made a little news. I was asking you to explain yield farming, and you did it in this way that sort of described a box that tokens came out of, and people put money into the box. And there was a sort of self-sustaining flywheel where people put more money into the box, the tokens were worth more, and they went up. And I used the Ponzi word in reaction to that. And you didn't exactly endorse that, but definitely the crypto market went down shortly after that conversation. And I wanted to revisit that a little bit. Like, you know, at the time, I think we were abstracting away from the usefulness of crypto projects and just sort of talking about tokenomics. But given that the token market kind of collapsed, like, what lessons should we draw about the usefulness? Like, how much of crypto at that time was kind of people investing because line went up rather than because of like usefulness of projects?
Yeah, and that is certainly something. Some of it for the whole space, and more strongly than that, it was some of it for many spaces, right? Like, I mean, Nasdaq's down what, like 40% or something like that since the peak, and so some of this is herd behavior. Some of it is herd behavior triggered by monetary policy, right? Like, to the extent that you know the world believed that there was going to be easy money forever, and you know all numbers would keep going up except for the value of the dollar. You know, people kept investing, and then there's a strong signal change, and all of a sudden people felt like numbers could go down because maybe money was going to flow out of this system instead of into it, and sort of everything came down in price, and so some of this is not a crypto specific phenomenon. Some of this is like what investing looked like at sort of peak mania. But I think putting that aside, I think that Bitcoin's price roughly reflects that dynamic of like inflows and outflows into the monetary ecosystem. I think that like certainly the asset price decline was a strong sign that in crypto and frankly in a lot of fintech, like things were way too light on use cases, and that there was a lot of hand waving going on both on use cases and on sort of financial modeling that was suspect. But I think beyond those two, you can look at things that didn't just fall 60% in this crash, but fell 99% in the fall, and that's when I think you start to look at things that were sort of worse than just like, yeah, there is a change in monetary policy, a change in investor sentiment. Like those are the types of things where there was probably artificial mechanisms sort of that were creating these flywheels driving it up with nothing fundamental backing it, and then the flywheel starts to falter and the whole thing crashes back down. And obviously Luna is like the prototypical example of that. Celsius probably you'd put in a similar bucket, and I think that sort of is a layer of which I think is a lot of the long tail space of crypto, and some selection of what were considered sort of more respected second tier places that were probably worse than just like monetary policy change.
I think that people say a lot about bubbles is that there's a sort of misallocation of capital, and like does that make sense in this space, like to talk about that, and like is capital being like sort of better allocated now after the winter? Yeah,
I think it is. I think it is, and I think it does make sense to talk about that. And I think that like where have the sort of re-ratings been, so to speak, whereas the relative re-ratings been? I think one thing when you look at the companies in crypto and frankly across the space, I think profitability was sort of a dirty word for a number of years, and it has returned to investor parlance, right? Like last year, if you saw a typical funding round from VCs, like was that valuation related to the profit of the company? Probably not. Like revenue was sort of like there's sort of, without saying so explicitly, everyone just subtly slipped from like EBITDA or profit or something to just purely revenue as like the driver of value, and like no thought towards like how profit would eventually catch up to that. And I think that there's been a substantial re-rating towards looking for at least likely or at least plausible pathways towards profitability being a core component of an investment thesis in a company, which feels a little strange to say, but I think was something that was kind of missing. And then when you look at tokens, I think that like there's this sort of question of like, if everyone woke up one day and this thing was missing, was gone, would anyone miss it, right? Like would anyone be like, oh shit, like someone has to go start the new this thing now that old copy was gone? And I think that that's been like a fairly strong predictor of which things have survived versus which things have not. And I think that like, obviously, like stable coins have survived, exchanges have survived, blockchains that have some property that is sort of like plausibly superior to other blockchains have survived, including just being like a more consensus, a mechanism with like more built-in consensus from lots of players, and things where like if they went away, you would forget they ever existed, have generally sort of gone away, and people have started to forget that they existed.
Can I ask what your sort of interest or knowledge of this is? Like in your day job, I think of you as like running an arbitrage fund and running an exchange that kind of like clips fees from people trading stuff. Like, how important to you in your job is it that things be robust or useful, and how much of it is like, if the number is moving around, then I can make a profit on it?
Locally speaking, it's mostly driven by the latter. Like, if you want to say like, what's going to determine how much revenue we make next month, like realistically speaking, like whatever, that's going to be a function of volatility and volume and monetary flows and things like that. And that's the same thing if you look at NASDAQ, right? Like what's going to determine NASDAQ's Q3 earnings this year? People aren't sort of looking at like fundamental, like long-term business models of things. People are saying like, well, I don't know, what's market vol going to be like? I think when you look in a longer-term view, though, I think it is quite important. When I said Jane Street trading, this is something that like some of the more senior people there would say sometimes, and I kind of nod along, but not really. Not that I disagree, but it didn't really sink into me. Which is, they say, look, sometimes volatile days can be good for profit, but in the long-run view, like we like it when markets are healthy and efficient and going up and stable, because that is in the long run what just creates more activity, right? And like, even if you ignore any altruistic things here, right, it's just like that's what long run, and I think there's a similar thing here where like how healthy the ecosystem is in the long run is going to be a very strong predictor of how much we can grow.
So on that note, I want to talk about one big symptom of the crypto winter is like there's been a blow up of a number of platforms that I would sort of loosely call crypto shadow banks, where they're sort of taking in short-term demand money from customers and lending it in weird, opaque ways. And you have touched in some form probably all of those. You've been a lender, a borrower, a rescuer. So like the natural segue is like, how much of the rescuing activity is about that very long run view of like it is healthier for the crypto ecosystem that you are levered to for depositors not to be constantly blown up?
That's a real part of it. Like, and maybe to make this like more concrete, like the explicit sort of like working principle we had in a number of these was like, it's okay to do a deal that is moderately bad. Right. In bailing out a place. Like the bar was not, this is a good return on investment. The bar is like, this is not that bad of a return on investment, or like we are incinerating a relatively small-ish amount of money in doing this.
And just to tease that out, you're incinerating a small amount of money because like in the long run, you get a large amount of money from the crypto ecosystem being
healthy.
I was going to say healthy, but I almost said popular. Like,
well, I think it's. I think if you want to look at it from just a strictly business case, right? And obviously, if whatever fiscal duty to shareholders to do things that make sense for FTX, you could say, look, it's it being healthy that would cause it to be popular, right? Like ultimately it's the popularity that would matter, but like that there's a flow through from health there, which is sort of the operative thing. I think there's also just a thing of like, we need to be a good constructive actor in this space. If we're not, it's just like bad on many levels, and ways that we can be, I think will sort of like be a diffuse good that like, whatever, we don't need to know beforehand exactly how that pays off.
So when I look at the things that you did, some of them are you sort of like, I'm going to shorthand it, you bought BlockFi. You did not buy Voyager, and you incinerated $75 million on Voyager and then said, that's enough, thank you. And then you, I think loosely speaking, incinerated no dollars on Celsius because you were like, that's definitely enough, thank you. Talk about like, talk sort of generally about how you make those decisions and like what, like, like like when someone's bad, like what's bad about them? When someone's like blown up but good enough to get an investment, like what were they doing right? You know, like give me a sense of what's going on there.
Totally. And taking a step back, like when we have to make the first decision, we don't yet know.
Right.
Sometimes which of those, like if you like called me up tomorrow night and you're like some very weird things happened and like I'm going to die if you don't wire me $2,000, right? Like I'd be like, okay, fine, let's deal with that, making sure you don't die, and then we can talk about what exactly happened to get us there. And like that,
except for Celsius.
Right, and maybe I'll tell a little bit about like the first conversation at high level that I had with. I'll give a model conversation. This is how I would like the first conversation to go, and it reflected some but not all of our first conversations, which is we get on the phone, and the other party says, "Hey, thanks for taking the call. We are sort of in trouble. It's a little ambiguous. Here's exactly where we are. Here's where our balance sheet is today. Here's our assets. Here's our liabilities. Here's the uncertainty in it, roughly speaking, ballpark. Here's where it's coming from." Pause for a second, you know, and
I want you to continue, but I want a little bit more, like when they say here are assets, here are liabilities, like which number is bigger?
Right. Yes. Well, I hear you. But an even...
Do they use numbers?
That's the first, right? The first test is not even which is bigger. The first test is, do I walk away from that first call feeling moderately confident that I know what the numbers are? Whether or not they're good, do I even know them, right? And like, that was like, sort of like the test for us to like consider doing like just some emergency thing while we figure out other things. One of the criteria was that we know what the numbers are, whether or not they're good. And some failed that test of like, not just the numbers were bad, but like we literally came away confused. And like we had a second call.
And that's not like valuation. That's
no, that's like we think either they're not being transparent with us or they don't know their own business.
Right.
But one way or another, they like cannot tell us the number in this account. And like whatever, you mark these into, but we don't even know how many shares of that illiquid thing they have, right? Like it's just like there's nothing there. And of course, no one knew how to mark 3 Arrows capital debt the day after this happened, right? Like that was one of the big.
That's like a number you put on it.
Exactly, right? We would have accepted and this amount of debt with 3 Arrows as part of this, right? So that's step one, is like literally, do we know what is going on? And then step two is like, right, we do kind of the obvious thing if we compare the two sides of this ledger, right? And like in the cases where it was most obvious to do something is when they are about equal, right? When the assets and the liabilities are like roughly the same number, and you can imagine someone saying, look, here's the outstanding uncertainties we have. It is plus or minus 20 million, depending on those uncertainties, right? That's the place where it's sort of like most obvious that we should act, because if we don't, they might be slightly underwater, and there are serious questions about like, do they have to take drastic corporate action? But for like a relatively small, you know, sort of like potential incineration of money, we can like resolve that problem and make them able to like continue operating and like carry on and not like cause contagion or customers losing assets or anything like that. So that sort of like is the best case. Well, okay, the best case is that I have tons of extra capital, but then why are they calling us? So okay, of the calls we might get, the best case is when they have about 0 left, right? And you know, they're like, look, we need a buffer here so that we can like definitely pay salaries without dipping into customer funds, like, you know, and we're like, that makes sense, right? And in those cases, like what we would tend to do is like, okay.
Because otherwise they would.
Well, depending on the company, right? Otherwise maybe they would declare bankruptcy, or maybe they would dip into customer, whatever. There's a lot of unpleasant choices there, right? And so in that case, what we'd say is like, okay, first things first, let's just give you a line for something, I don't know, 50 million, whatever. Something that is like definitely bigger than the like plausible downside here. So you definitely have a surplus. And we'll make it junior to customer assets. And it's an amount of money where if we totally misunderstood this, like, it's okay, it's a little sad, but like whatever, shit happens. And then we can talk about what's next.
Junior to customer assets, is that purely being a good citizen for the ecosystem? Because it seems like people can not do that. It seems like one option is to not do that.
Yeah, so the way I see it is like, there are cases where it makes sense to do it, not junior to it, but it doesn't actually solve the fundamental problem here, right? Like, and so like, I think basic the answer is like, yes, like, I don't know, I would feel kind of like, I don't know, we're giving you this senior line, maybe it's useful for you, but this isn't like, I don't feel like that solved their the problem that, morally speaking, it hasn't solved their problem, right? Like, I think basically, yeah, like that seems like a shitty way to structure it.
What can you tell me what the problem is? Because there are two sort of broad ways to characterize the problem, which is like run on a bank or balance sheet insolvency.
Oh, totally agree, and that's a good point, which is that there's sort of liquidity versus net asset value at the, or whatever, however you want to think about it, and the junior versus senior thing is primarily a net asset value type thing of like, at the end of the day, will customers get their money back eventually? Whereas a senior line can be useful, and it can be, and so the senior line is something we would absolutely consider if what was going on was they had a mismatch in durations. So one hypothesis about Celsius, which did not turn out to be true, but which was speculated about, was that they were completely, totally fine, except that they'd taken a lot of customer Ethereum and staked it on ETH2, and that it was going to be about a year before they could realize that ETH2, and the customers might try and withdraw before then, right? And in that world, then actually a senior line of Ethereum floated to them equal to that balance would be all they needed, right? And so if it's just a liquidity crunch, then absolutely, like, senior line's totally fine. If it's a net asset value crunch, then it's a lot less clear that a senior, that senior debt is super helpful there. And by the way, like, the different platforms took completely different approaches to how much they gave a shit about the net asset value version of this, right? Some of them gave many shits, some of them did not. And
what do you mean, like?
Well, so like, everyone had to care about liquidity, right? If customers try to withdraw and you can't fill the withdrawal, your business ends. So like, that's clear to people. I'm being a little bit like apocalyptic.
You're saying some people didn't seem worried that their equity was negative.
Yeah, or whatever. There's definitional things going on here, right? You can mark things to whatever, you can serve, but like, there were a lot of cases where I think like we felt like they had been maybe less than maximally responsible in terms of their actual underlying financial health.
Well, I mean, let me ask a general question. Like one thing that I think is striking about these situations is that, like, their healthy situation was like 20-to-1 leverage.
Right.
Where, like, the liabilities are demand deposits from retail customers.
Yep.
And the assets are unsecured loans to fly-by-night hedge funds and, like, investments in volatile assets. Like, what happened? Like, can you, like, how does that happen?
Right, okay. So let me describe two different things one could have done. Thing one, lend $1 billion to 3 Arrows Capital and take $1.3 billion of random crap as collateral.
Right.
A second thing one could have done is the first half of that sentence.
Right.
Right? Without the second half.
Right.
And I think that there's a very big difference between those two, right? Like, fundamentally, there's risk in both, but with the first one, optimistically, the risk that you're looking at is like maybe something illiquidity market move, quick something, and there's like a 10% haircut on that if you get unlucky. It's sort of like maybe they're so illiquid that it's much more than that, but like, the second one is like something 100% haircut. Like, and so I think that like unsecured was like a relevant piece of what you said. And I think an interesting thing is that like that was a very big determinant of whether a platform blew out. Is if they had debt with 3 Arrows, was there collateral posted in return? The interesting thing is that like some platforms did, some platforms didn't. That completely changed the situation. But from an outside perspective, what was the incentive mechanism on them to bother asking for the collateral? Like, obviously, at this point, a lot of people wish they did, but like, so much is about the details. Details, I mean, it's sort of a big detail, but like,
where did we put all our money?
But it's not like you open up the app and this is obvious, right? It's not like it's sort of like an obvious functional part of the product. Some of these were coin flips about whether they bothered asking harder for collateral or not. And like, it's an incredibly important decision, but it's one which like there is no punishment for at all what you did until everything blew apart. And there was no, and like if you're thinking about like what could regulation have done here, right? I think one thing that regulation would really want to do is like ask, is there collateral, right? Like that seems like a really important perspective that like there should have been some amount of oversight or transparency or like, enforce good risk management on, but there just wasn't. And again, from an outward facing perspective, no one has any idea whether or not you actually got that collateral.
Like, why does 3 Arrows need so much unsecured lending? I mean, like, broadly speaking, they're a hedge fund.
Right.
They're financing positions. Why aren't they pledging the positions that they're financing?
Well, at the end of the day, they sort of ultimately did, in that their positions are all gone now. Now, that's
Why are they pledging them to Celsius? But okay.
Right. Well, okay. Maybe they pledged them to Celsius and also to many other people at once.
Sure.
It's
Yeah.
But
that's what unsecured loan is.
Right. But maybe another way of saying this is like, how did they lose so much money? Is like fundamentally, it's not that like Traders' positions were illiquid. I think they were just like lost money. Like at the end of the day, their net asset value is very negative, and if you get into that position, like nothing, like people lost somehow, right? And I think basic answer is like, I don't know, they were like probably, I don't know exactly what they're doing, but like that certainly hints at them not being like a sort of like low risk arbitrage firm, and more of a like had giant positions on, and sometimes they did well and other times they didn't type firm. And I think that their like debt was probably rated, treating them as more of an arbitrage firm, and their trading was probably much more punting than market making.
So your hedge fund also borrows from these platforms, like, or borrowed, I guess. Can you talk about like sort of what's, like, is that sort of like ordinary course financing positions? Is that arbitrages? Are you secured?
It's all, so again, there's some variety here. Generally, they're at least decently secured. Often they're oversecured. And I think basically like part of the underlying thing here is it's hard to get capital into the crypto ecosystem. Like there's giant bottlenecks, regulatory, among other things. And so the spigots that you do see are like people will like develop some sort of spigot to connect non-crypto money with crypto money, and then sort of like grow the hell out of it and like try and get as much as they can through that spigot because the other spigots aren't working. And this has been one of the ways that capital got into the crypto ecosystem in the first place. Obviously, there's been a huge outflow of that capital, not surprisingly, over the last couple months.
When you say this, like retail deposits on these shadow banks, which are like
as an example,
crypto money, yeah.
But there's others. So there's institutional money in there as well.
Yeah.
It's not all retail.
That institutional money is functionally like we're going to give money to a platform which is going to lend it out as sort of senior claims on crypto to crypto hedge funds.
That's basically right. Yeah.
Okay. So you're getting all these calls about rescuing. Why are they calling you? Like, why aren't you making the calls? Like, what's the difference between like you run a sort of exchange, you know, like what are you doing right?
Collateral. So, well, but seriously, like that is sort of, and this actually interestingly ties into our CFTC application just to some extent.
Yeah, right.
You know, when you look at what is FTX, let's ignore the spot trading for a second and just look at the derivatives piece of this, right? Where, although spot margin, whatever, looks a lot like derivatives in some lenses, the way that a risk engine works effectively is, you know, your cousin Jill wants to, I don't know if you probably don't have a cousin Jill, but pretend you did.
Sure, I can do that.
Yeah, cool. You can substitute the name in your head for you, right? So, you know, Jill has a family office that wants whatever to put on a $100,000 Bitcoin futures position, right? Step one is know your customer process, blah, blah, blah. They have an account now. Step one of the like trading piece of this is not them sending an order. Step one is them depositing collateral to the clearinghouse. So, you know, they deposit $30,000 of collateral to the clearinghouse. Clearinghouse recognizes it, says, great, you've got margin, puts on a $100,000 position. From the clearinghouse's perspective, there's no money outside of that $30,000. Like, it's not saying, if Jill loses on this, that's fine, we'll call her up. It assumes she will not take that phone call, and that the risk engine has to manage this such that that's okay. It has to manage this such that, you know, Bitcoin starts going down, that amount of collateral remaining starts to decrease. Eventually, issues a margin call. It has to do that before that number goes negative. Like, it has to do that while there's still positive amounts of remaining equity value in the account, with the goal of never having any account go negative, even given no recourse, given that like you can never call someone up. A different model that you could have is step one, Jill puts on a position. Step two, Bitcoin goes down. Step three, you call up Jill and you say, please deposit $15,000 because that's the amount that your position is underwater right now. Model two, the risk is that she doesn't pick up the phone. right? Maybe she doesn't have any money. Maybe she would prefer to have the money than to give it to you. Many people would prefer that. For one reason or another, right? If she doesn't pick up the phone, you've got a hole in the system. You've got a $15,000 hole in the system, and that's got to be either you're paying out of pocket or it's socialized or something. The way that we try and structure it is that they don't pick up risk because we require collateral deposited beforehand. And so what that means is, there's a big market move. And in fact, some of the names that you've heard about had accounts on FTX, but like they had collateral there. And like if they refused to answer a margin call, like eventually we deleveraged their position while they still had non-negative account equity value left. And so there's no overall contagion or hit to the system.
Would you say that like there was stressing or testing of your kind of like liquidation models during the last like month or two, and like what did you learn? Yeah,
so I mean, Bitcoin fell from like 30K to 20K at around 11 p.m. on a Sunday, I think, roughly, which is it's not the most liquid time in the world, and so we got to see empirically like, okay, we had how many billions of open interest, like some of that was levered long. Like what happens when there's a 30% market move, triggered over a 2-day period roughly, I will say that I had a business trip that week. I was flying out like Sunday or Monday, and like when I sort of got to the place, I was like, this is dumb. I should fly back to the office. Like the market literally just dropped 30% since I like took off. Like I need to be at work, not like dicking around here, like trying to talk with outside parties. And I sort of like called people and like looked at Slack, called people, and one of the most surprising things to me was that like there actually like nothing was on fire in terms of like our systems. Like ultimately I did not fly back, and it was fine.
What would you have done? Like, would you have like hit the liquidate button faster?
Well, that was the thing. The answer is there's nothing for me to do, right? I sort of like, hey guys, can I help? And they're like, what would you do, right? And like, is there anything that needs help? So like, I don't know. Do you want to buy Bitcoin? Like,
did you? That would have helped.
It would have. Well, we did have real conversations at some point about like at what point. So FTX keeps its treasury in dollars. Like we did have conversations at some point about like at some point we just buy Bitcoins, right? Like there was a price. We did not hit that price, but we had a price in mind of like at this price we will start to buy Bitcoin.
And that would have been out of FTX.
Yeah, it would have been. And yeah, I don't like actually operate Alameda anymore day to day, and so it's. They were sort of doing a variety of trades, the details of which I don't know, but like at some point FTX could purchase crypto on its own balance sheet. It's like not exactly a hedge for a business, but I mean, right, at some price, sure, right? Like
yeah, I mean, and it's in the same vein as sort of everything else, which I've talked about, where it's like like the nice way to put it would be being sort of pro-social to the crypto ecosystem, where like you are bailing out depositor-facing platforms.
Right.
You're buying Bitcoin.
Yeah, and sort of some of this came to the question of like which needs a bailout more, Bitcoin or depositor-facing platforms? And I think our answer is depositor-facing platforms. But you could imagine a slightly different world where the answer is Bitcoin, right? Yeah. Where like there's more sell pressure on the asset and fewer under-collateralized platforms, in which like that would have shifted that calculus a little bit there. But yeah, it's basically nothing was on fire. It sort of like worked somewhat smoothly.
And under-collateralized platforms are in the long run sort of supportive of crypto generally, or if you're bailing them out, right? Like you're getting people back in.
Yeah, getting people back in, making sure that there aren't customer losses, making sure there's some contagion that spreads through the ecosystem of like debt on debt on debt, sort of like collapsing. And I mean separately, I think there are like hard risk management questions that a lot of these platforms would need to ask themselves, even in the case where they're fully made it through this event.
Right.
But like that's step 2, and step 1 is like stabilize, and step 2 is like think about whether this business model and this implementation of it made sense in the first place.
Yeah, I am curious, just like why people thought running 20-to-1 leverage with this model worked, and why people let them.
Yeah, well, so on the let them, again, it's not even clear you could tell as a customer what the leverage was, right? Which is a problem in of itself, but
they're like, it seems to me that there are institutional players facing places like Celsius and Voyager, and the fact that no one was like 20-to-1, huh?
Well, so the institutional players don't necessarily see their whole book, right? Like like they don't necessarily know if most of their loans were over collateralized or not at all collateralized. And the platforms themselves were the only ones who saw their whole books and actually knew what those, and like, you know, we sort of got to look at a lot of those books after the fact when we were sort of in bailout mode. But I did not know prior to that exactly what state each of these places' books were actually in to begin with. And they'll all give you pitches, which are probably a little over-optimistic on average about what their real risk looks like.
So we only have like a minute left. I want to just quickly ask about effective altruism. Like one model for your kind of like utilitarian calculus is that that a lot of people want to gamble. Crypto is both a good sector for gambling and a very efficient way to extract fees from gamblers if you run a crypto exchange. And you are sort of in the business of funneling money from people who are going to use it poorly on gambling to like animal charities and pandemic preparedness and Joe Biden. Is that too cynical of you, or is that not cynical at all, or what?
I think it is too cynical. I think this is also something I've gotten more appreciation for over time. I think I sort of like had much more unformed thoughts of this earlier in my life, but you know, I think I've increasingly come of the view that like it is, at the very least, I want to be doing something net positive, like with the making money part. Like I want to be a good actor there, and I think that like part of it is just like it is unsustainable if you're not, and has a huge number of bad flow-through effects, and is destabilizing for society to some extent. And so I think like, you know, I like am to some extent in the business of like, you know, making money and then giving it away. Like that is absolutely what I'm in the business of. But I do want to try and make sure that like that even if I think a lot of the value is created in the second step, that first step is not destructive.